Welcome back to Go ESG ASEAN Conference 2021, organized by UN Global Compact Network, Malaysia and Brunei. My name is Rahim Rahman, back here again for more of the panel discussions and also fireside chat that will take you through all the way until 5 o'clock today. Right, time for panel discussion number 5, titled Pushing the Sustainable Finance Dial, the Role of National Institutional Investors. The panelists for this session are Mr. Damian Graham, Chief Investment Officer of Aware Super, Dr. Srikanya Yathip, Secretary General of Government Pension Fund Thailand, and yang berbahagia Datuk Sri Amir Hamzah Azizan, Chief Executive Officer of Employees Provident Fund or EPF. Now, moderator for this session, he is the head of Asia Pacific at BloombergNEF, a research group within Bloomberg LP covering clean energy, advanced transport, digital industry, innovative materials, and commodities. He currently manages the company's research and consulting businesses across a dozen countries in the region, working closely with governments, investors, and corporations to help them develop business strategies in the low carbon transition. A leading expert on renewable energy, corporate sustainability, and decarbonization policy in Asia, he has been quoted extensively in international media and has previously testified before the US Senate Committee on Energy and Natural Resources. He is also a regular contributor on Asian energy issues for Bloomberg Radio and Television. Ladies and gentlemen, moderator for panel discussion number 5, Mr. Justin Wu, Head of Asia Pacific at Bloomberg NEF. Over to you, Mr. Justin Wu.
Thank you very much for the kind introduction, and good morning and good afternoon, everyone. Thanks for joining us for this panel. I'm really honored actually this morning to be joined by 3 very large government institutional investors across the Asia Pacific region, and to discuss a very timely topic. Just before we start, actually, I just want to highlight 2 points which I think are really interesting. We're now near the end of November in 2021. It's almost 2 years, I think, since the pandemic has started, and we started this virtual conference. I'm sure this is still something very much ongoing and on everybody's minds. But actually, in the last 2 years, I think there was also 2 very important turning points that has happened. One is that the amount of the rise in corporate sustainability and interest in ESG. So actually, as of now, almost 90% of global emissions are now covered by some sort of net zero goal announced by countries, as well as by companies. At the start of 2020, this was less than a third. So this has truly turned around in the last year and a half. The second number I want to highlight is actually the amount of sustainable debt that's been issued. As of the third quarter of this year, over $1.1 trillion of sustainable debt issuance has occurred across the world. This is up from just under $500 billion in 2019. So again, a tripling of this, and the year is not even over yet. So yes, the pandemic might be on our minds, but actually, something greater is also happening behind the scenes. So with me to discuss this and also to explore a bit further are 3 panelists today. So Amir, let me start with you. Maybe you can give a brief introduction to yourself and your firm, and tell us, how did sustainable finance become an important topic for EPF?
Thank you, Justin. My name is Amir. I am the CEO of Employees Provident Fund Malaysia. For those of you who may not be aware, just a little background, we are one of the oldest provident funds in the world. Yeah, and currently we have just over 15 million members. As of the second quarter of this year, our asset under management was just under $250 billion, and we are a globally diversified asset base and participating in about 40 markets in the world. So as you're aware, fundamentally, as a provident fund, our objective is actually to look after the welfare of our members so that they have a better retirement and going forward. So sustainability financing is actually very fundamental because it is the natural evolution of the world today, moving to a much more responsible, balanced approach. And in EPF, we have embraced that as the core of our organization. And fundamentally, we aspire that by 2030, we will be a fully compliant ESG organization. And by 2050, we'll be climate neutral by that point. So it is a guiding post in terms of how we will evolve as an organization.
Okay, thank you very much, Amir. Damian, can you tell us a little bit about Aware Super?
Thanks, Justin, and thanks everyone for the opportunity to talk to you today. It's a real privilege to talk about sustainability. So Aware Super, and again, many may not know our organisation, but we're based in Sydney, Australia, and we are the default fund, which is a pension fund, the same as Amir, effectively, for many of the public sector workers in a number of states of Australia. We have about 1.1 million members and about $160 billion of assets. And we invest around the world as well. So it's a very similar sort of approach. Justin, to your question around sustainability and why it's so important, we refreshed our investment beliefs a couple of years ago. And one of the investment beliefs is that we believe that being a responsible owner of our assets really drives strong value and is aligned to our members and their values. And really at the core of that responsible ownership is to be able to deliver sustainable outcomes and long-term outcomes to our members who are with us for many decades. So it is really in the DNA of what we try to do, because we think it drives better investment outcomes and obviously has a positive societal impact as well.
That's great. Thank you, Damian. And Dr. Srikanya, can you tell us a bit about GPF?
Yes, GPF is a government pension fund of Thailand. It's comparing to Amir, we are a very young fund, only 25 years old. And we are a defined contribution fund with AUM approximately 33 billion US dollar. Currently, we invest both domestically and globally. And to address your first point about the relevance of financial sustainable finance to our organization, actually, I agree with Damian and Amir. It's easy to be the third person. You just say you agree with both of them on before you. But just want to add one more point only. What we see is, I think ESG or sustainable finance, they're involved incorporates the risks, which is a non-financial factors. And we are admitting that it is those kind of risks are interplaying with financial market and financial consideration. That's how we think we cannot get away with not taking care of a sustainable finance. Thank you.
Thank you, Srikanya. I think there will be a lot of agreement actually on this panel. So let's pick that apart a little bit. And clearly, yes, there's growing recognition, as we mentioned, of climate change as a priority. I think that's all affirmed by COP26 that just happened recently. And I like to think that the three organizations, the institutional investors are really the top of the food chain, if you will. Companies have to listen to you at some point, right? There's some level of accountability there. So we see that a lot of companies now have also embraced corporate sustainability goals, net zero goals, and of various degrees around the world, including in the Asia Pacific or ASEAN region. So I'm curious to hear sort of what do you foresee as risks or opportunities faced by companies in the region specifically, let's say in Southeast Asia specifically. Amir, do you have any thoughts about that?
No, I think the reality is the sustainability wave is quickly growing and spreading around the world. The key for this from institutions such as ourselves is to facilitate the shift in a proper manner. At the end of the day, I'm also cognizant of the fact that EPF has a very, very large footprint from a Malaysian point of view. 70% of our assets are actually domestic. Yeah. So in order to facilitate the change, it is important that institutional investors push and facilitate movements by organizations. So in our perspectives, the shifts in sustainability open out new areas of growth. Yeah, I think the renewable sector is probably one of the most visible change, and in particular the Asian region, we are fairly heavily dependent on fossil fuels still as the base feedstock for energy. So the key is how do energy transition occurs in a good manner, and more importantly, in newer economy areas, what are the new areas that we can develop? And I think the pandemic opened up a lot of technology plays, logistic plays, and all these things that has actually changed the dynamics of businesses going forward. So for us, it's how you manage the risk and how do you balance it and incorporate that into your portfolio.
I think we'll get to that point in a bit more detail later, Amir. But it's good that you raise, how does it actually reflect in your investment decision portfolio? Damian, I want to ask the same question to you, but actually add something. You mentioned about how Aware Super, came to think about your responsibilities in this area. Can you tell us a little bit about how sort of this happened? Was it that the companies or your investors, the people giving you money, did they actually demand something from you, or was this more sort of internally in the organization that you decided to incorporate ESG, incorporate the emphasis on ESG?
Yeah, well, I think it's a little bit of a blend of both, Justin. So I think we certainly have a fiduciary duty as trustees of our members' retirement savings. So I'm sure that's consistent around the other organisations. So we feel that it's strongly aligned to delivering better long-term investment outcomes, and that's a critical part of our fiduciary duty. We also get lots of feedback from our members that they care about sustainability and they care about the ways of driving better outcomes and having a positive societal and community outcome. So, it's a very aligned, but we do think about sustainability from a value perspective, not values. We are saying it's strongly aligned to better value and better investment returns, but obviously has a positive impact and a positive alignment to our members and what they care about as well, so their values. So it's a very nice virtuous circle, effectively, around that issue. I was just going to pick up to just one of the comments you asked about companies and how we think about that. One of the things I've found most challenging in the last few years as we've thought about this issue is just the different taxonomies and the different measures. We're invited to, our organisation was invited to sit on a global initiative around sustainable development goals with 29 other organisations globally. And the process that was gone through in that discussion was to put together a summary of all the taxonomies on sustainability. And there was a presentation pack that was 50, 60, 70 pages long with a taxonomy every page. And it was just so confusing to think about how we're going to wrestle this down to ensure that we've got consistency of measurement, consistency of language to really drive forward and guide companies we invest in to care about the things they should care about. So I think that's one of the challenges I see as to how we provide that guidance and clarity.
Yeah, that's a really good point. Actually, that sort of is one of my forthcoming questions about reporting mechanisms and standardization. But we'll get back to that point in a moment. But Srikanya, let me ask you this similar question. Maybe shed a little more light for us. When did this happen? Sort of, at which point did you say that, okay, well, ESG is really important. We need to incorporate it into the way we think at GPIF. Was it something that the companies, your portfolio companies, pushed you to do this, or was it something that happened more internally? Sorry, Srikanya, I think you're on mute.
Sorry, I don't quite get the question, but I try to answer my best. First of all, I like to say that I agree completely with Amir and Damian, especially when you talk about taxonomy. I think the big challenge, as Damian just mentioned, is there's a big challenge for us all. But in my case, it will be double because you have to do the translation into our local language and interpret within our local context, which could be different. And also the ambition of the country, ambition of the companies could be different. So this is a big challenge. I think I heard what Damian and Amir have said about the risks and opportunities from the context, from the point of view of investor. But I'd like to share some observation from the point of view of a corporation that we are investing. We see as in Thailand case, I would say, in Thailand case, if a regulatory is identified as black and white as the rules, it would be a corporate risk if you ignore them. And we see the big movement in Thailand recently that the government pension fund ourselves and also Stock Exchange of Thailand, Stock Exchange Commission, those kind of policy makers are trying to initiate regulation and rules so that companies have to comply to those kind of rules. And I think this is one thing you cannot get away with it. Another thing that I see a movement or activities in Thailand is the location of operation of corporation. If the physical location and the nature of operation of company or factory cause natural problems, those companies cannot ignore the fact because that you would have to fight against community and also the NGO who would take the case into the media, and then that's another risk. The last point regarding risks, I would like to say from license to operate in terms of legal standpoints and stakeholder standpoints. You may be able to have a company, but then if the public and NGO against you, you don't have the license to operate anymore in Thailand. I think the movement is kind of strong in Thailand so far. And then when you talk about opportunities, I think actually there's a lot of opportunities if the companies have the mindset that climate change is a fact and countering is a must, it's not an option anymore. And then you have to also be aware that climate protection makes economic sense, and it would be more expensive in long term to pay for damage it causes. If you have that kind of sense from our engagement, I see that the company that the executive have this kind of sense, they would do both steps to adapt the business model to reality to climate change. And that is a progress and there's some opportunities. The company would be seen as a kind of industry leader that trying to do well by also doing good, and there would be a lot of opportunity for not just brand image but also market share. That's how I see it. Thank you.
Thank you. Yeah, actually, on the topic of opportunity, let me ask a question that might be on people's minds, and you know, in a bit more detail. You know, could you share with us specifically, you know, how are your fund managers actually incorporating ESG considerations into investment decisions? And you know, specifically, you know, does it impact returns, right? That's at the end of the day, people want to know about that. Amir, do you have, you know, how does that work at EPF?
No, as I said, this is a natural evolution of how the portfolio moves over time, right? So what we've been trying to do in EPF is actually incorporate measures and guidance that we give not only to our fund managers, but also our investing companies in terms of expectation, because overall EPF has set its own goals in terms of where they want to get to by 2030 and 2050. Yeah, the key is to make sure that because as I said earlier, 70% of my investments are actually in Malaysia, so my footprint is actually very, very big. Yeah, so it's very easy to espouse goals and stuff, but if you do not facilitate the goal, yeah, you do not explain and manage the goal, you may have a lot of unintended consequences. Yeah. So the challenge for us is actually to make sure that the process is managed in a particular way. So we set aspirations in terms of what our fund managers have to do. We encourage them to incorporate ESG measurements in what they do. Yeah, and we want to encourage that the investing companies embrace the challenge in the way that they want to go ahead. And this is a journey. It's not something that you can achieve overnight inside it. And I don't think sustainability and returns are mutually exclusive because fundamentally it is a shift. It is a shift of good, responsible investments that has actually gone ahead. So if you do not follow that directionality, you can be left behind and run the risk of stranding the asset itself, right? So fundamentally, it is a movement that has been picked up, as Srikanya says. Yeah, similar to Thailand, in Malaysia, I think our investing companies understanding that is the pace of what they pick up, and what we do as responsible investors to facilitate the shift faster.
Just a follow-up question, Amir. I mean, you mentioned that this is a journey, but recently, do you see that your fund managers do you see the speed of this accelerating, or do you see that actually this is impacting more and more decisions that your fund managers are making?
I think the reality is the appreciation of the sustainability journey is a lot more better understood. So from an EPF point of view, laying out our guidelines, guidance in terms of policies, sector policies that we require, and all this is important, right? And that's what we've been doing, so that the education phase actually is there. But the second thing is actually seeing the investee company itself, and what they actually do. So we've been very encouraged to see statements, commitments, and stuff undertaken both at the investee companies, because ultimately that's where change has to occur, and the fund manager in facilitating and joining the journey of actually encouraging the investee company to move along that pace.
Okay, thank you. And Srikanya, maybe I'll move to you next. How do you tell us about your fund managers? I mean, do you say their behaviors are changing, and are they incorporating more ESG considerations in investment decisions? And does it impact, does it change the way they evaluate the impact on their returns in the portfolios?
The answer is yes. The answer is yes. But if you ask me more, if you ask me how do we know whether the ESG attribution related, how to call it, return attribution relating to ESG, I cannot answer that. I think it's very hard to try to quantify that. We understand how much our portfolio look like when you come to, within the ESG context. But to translate the ESG contribution into ESG related investment return is hard to quantify. Even somebody can quantify. In my understanding, it's hard to believe the data. I believe there is a relationship between ESG indication and good company return in long term. I believe in that. But a causation effect in a positive sense, in terms of financial return, investment return, I doubt that. But on the opposite side, the causation in negative sense is clear. If the company does not do anything comply to ESG, you can see a causation in negative sense is clear. But positive sense is not that clear. However, in our company, the fund manager that we are working together with, we make it clear that we are serious about ESG integration and process. And what our fund managers doing together with us, they try to monitor the carbon data closely and try to identify key environmental risks and other ESG risks and into their portfolio. And quarterly, we do a kind of engagement and a discussion with them. And they have to report to us what is the net zero roadmap, how they do the proxy voting, and whether the guideline of the proxy voting in line with ESG based practices or not. And then they have to also report on seasonal highlight, whether it's about human rights, racial equity audit, net zero greenhouse gas emission, those kind of things. That's our external fund managers have to do that together with us. And also they have to report on their engagement with companies that they are investing on our behalf, whether those companies are doing their best to try to reduce the carbon impact or not. If not, what would be the action from our external fund managers? So that's how they are doing. In terms of reporting, what we get from external fund managers come in many form and many point of view. But most of them is about ESG. It could be ESG characteristic summary, benchmark against portfolio, rating distribution, profile of top and bottom position, and momentum, ESG momentum, leader, stable, moderate, low, very low, secure, those kind of thing. And this is the quarterly engagement that we are doing together with our external fund manager.
Okay, thank you. Damian, I mean, do you think, she kind of mentioned that, it's hard sometimes to draw that quantitative connection. Do you think that's important to do that? to make that connection? Or, at the end of the day, it's more like, well, if you're not on board, that's worse, right? As long as you're on board broadly, it's okay.
Well, I think we've got to attribute the value. Again, what I'd certainly agree with my colleagues is that you don't want to do that over a short period of time, because I think year to year it may add value, it may not add value to have particular ESG biases or not. But on the longer term, we believe it does add value, and that's the driver of why I think we're all focused in this area, but also wanting to make sure that we don't overreact to short-term deviations. One of the things that we've done as an organisation is some internal research around what we call long-term value creation drivers, where we believe that we've identified what companies and management can do and what they do to drive long-term value creation. And we've embedded that into our internal systematic equity or quantitative equity strategies as one of the factors that we utilise to define the signals that we then trade on. And we believe that adds value, although obviously not every month and not every year, but we believe on a long-term basis it creates value for companies. So I think there is ways to think that through. As another example, we've created an internal index that is a low carbon index for our companies, for our internal managers and our external managers. And we utilise that for our passive and our quantitative equity strategies. And we've reduced our carbon footprint by about 45% over the last 12 months. In our listed equity portfolio. So material, and obviously something that we want to continue with. And we believe, and when we attribute the value, that's actually added a small amount of value compared to a non-carbon constrained index over the last 12 or 18 months. But we know that it won't always happen that way. So some years it will add value, some years it won't add value. But we believe on a long-term basis, and it's certainly the point that Amir made before, is taking that position we believe will reduce the risk of having stranded assets in our portfolio, and that's a critical piece. And obviously the unlisted assets are even more relevant, where you can't trade in and out of them on an easy or a short-term basis. So we need to make sure that we're embedding the ESG risks into our modelling and into our due diligence on these assets to ensure that when we acquire them and when we're measuring their footprint through time and undertaking the impact measurement framework, we're truly understanding what their opportunities are to reduce their carbon emissions longer term, so that we can be reducing the carbon emissions of the total portfolio. And so I think there's a lot of that effort you can take. And then as has been mentioned again, you can then start to talk to the external companies, engaging with the companies and understand what their journeys are around reducing their carbon emissions. So, there's so much that you can do across a portfolio to really look to reduce the carbon emissions of the portfolio and make it more sustainable. But it's not an overnight fix. There's a lot of effort to put in, and it will take many years to get there, we think anyway.
Damian, let me ask you about the portfolio, actually. That's a good segue. Do you think it's important to use for an institutional investor to use your influence and ability to help or even force your investee company or portfolio companies to increase the ambitions and reduce emissions? How do you see that? I mean, do you sort of take a more active role in doing that? And of course, across the whole portfolio, there are going to be leaders and laggards, right? So how do you look at that? Damian, you want to maybe comment on?
Yeah, I mean, certainly I can start. And from my perspective, engagement's important. So we actively engage with companies. We define a target list of companies that we want to engage with. And again, a little bit like Amir, with regard to the country that you live in, you tend to start there with companies that you have a heavy exposure to. You might be more exposed from the size of ownership. So we have a target list of 20 Australian companies that we engage with on a very regular basis. We want to understand their approach to a number of different issues. It's not just about climate. It may be modern slavery issues. It may be diversity issues. It may be remuneration issues, conduct and culture, or it might be climate. And so we engage across a number of different areas. And really the goal there is to help understand what their plans are to ensure their business models are sustainable. And it's fascinating to me. People will ask me, well, here's a fossil fuel generating business. Why do you own them, or what's their thinking? And my experience is that they're very focused on ensuring their business is sustainable longer term as well. So this is not new news to them. They're actively involved in trying to put in place strategies to reduce their carbon emissions and increase their sustainability. So we work with them, we understand what their planning is, we try to guide them, but obviously it's up to that company at the end of the day as to how they want to progress. But we certainly provide our thinking and our input appropriately as an investor to how we think they should be thinking. And some of them react more significantly than others. We took a decision about 12 months ago to divest from thermal coal producers. So we no longer hold thermal coal producers in our portfolio. But that wasn't the first step. That was the last step for us, because we want to engage with these businesses, and we had engaged with them for many years before we formed that view that we didn't feel they could adjust and transition as we needed them to.
I was going to ask a question about whether you would divest from a company if it didn't meet certain criteria, but I think I think you sort of addressed that point. Amir, what about you? I mean, for EPF's perspective, I mean, how do you engage companies, and do you feel there's a role for institutional investors to really push companies in the right direction? And would you drop a company, for instance, would divest if it doesn't meet certain standards, for instance?
I don't think it's a role. I think it's an obligation of the institutional investor to do it, because fundamentally you need to drive the portfolio in a way that actually fits the long-term sustainability. So from an EPF point of view, I think by the end of this year, we'll be issuing out sector policies and guidelines in terms of what are the key markers for us from an ESG footprint. So these are, at this juncture, a minimum requirement. So after that, what we've been doing over the years is actually active engagements, like my other colleagues here, right? You go down, you talk to them, you make them understand, you appreciate their challenges that they have, and you adjust. And in that whole process, what we encourage to do is actually move the investee company to actually do the right thing. But after a point, when we cannot see the clarity of the directionality, we cannot see them taking the active step, then the ultimate choice for the portfolio is actually to exit that when they no longer fit your sector demands. And I think from an EPF point of view, that's what we've done. We've drawn the line in some areas, and we said, look, we're not going to be in. So sometime back, we were invested in tar sands, for example. We no longer invest in tar sands, right? Because we don't believe that, despite the fact that today, if you look at where oil price is, I wouldn't be surprised the yield there is actually quite good. But we won't be in it because the returns don't justify the consequences that we actually have. So, but the key is actually put out what is your guidelines, put out what is the expectations that you actually have, engage actively with the entity so that you facilitate the change. Don't just be a spectator at the side and decide on the side. Be an active participant to shift in the right form. Then you help shape your own portfolio in a better form.
Amir, you mentioned that I think 70% of your investment is in Malaysia, right? Correct, right? And on this point, maybe there's a larger Malaysian audience at this conference, but can you tell us a little more about Malaysian companies specifically on this measure? Do you feel that they is it more mutual, that in terms of what the investors are sort of pushing, or you moving in parallel, or do you feel that actually investors are often a bit more forward thinking in terms of meeting ESG or sustainability goals than companies, or actually companies now are actually, I know that some Malaysian companies actually have been quite ambitious about setting goals as well, but we feel that they're the ones actually leading this a bit more in the Malaysian context, let's say.
I think fundamentally it's important to have very good alignment, right? Ultimately, when you talk about climate change and things along that line, it must fit in also where directionality the nation is actually going. So, and the key for us is to make sure that from a governmental policy all the way down to application at the investing company, it actually aligns in a particular form. So Malaysia has embraced a desire to reduce its carbon footprint quite aggressively along the way. And what we do as an institution is to encourage our investing company to actually push along that journey. And I think in the utility side, we've seen that shift. The biggest utility in Malaysia, Tenaga Nasional, actually came out with a lot clearer game plan in terms of how they're going to make their transition. What are their commitments by 2030 that they're going to do with respect to no longer having greenfield coal plants, then not renewing the coal plants that expire under PPA and stuff. Those are very, very strong commitments along the way. And it came in because first, I think clarity from the government sector point of view, where we are going, commitment as a nation. Second, institutional awareness of what is needed, how to do it. Third is the infrastructure to facilitate measurement and doing it. That's why taxonomy is very important. So we see very different institutions from the Bursa, the Securities Commission, Bank Negara, all coming in to facilitate the development of consistent reporting mechanisms so we can all measure things in a good form. And third, I think is active participation from the shareholders. Shareholders coming in and suggesting that this needs to be, and it's a commitment. It is a stake in the ground that we all commit to, like EPF committing 2030, 2050. Yeah, we haven't figured out how we're going to get there. Yeah, but it's important to put the stake in the ground. Then we work towards that goal, and we adjust, we push, and the active engagement actually facilitates that shift. And as I said, I'm encouraged to see a lot of shifts coming in from institutions in Malaysia.
Absolutely, yeah. No, I think that's a good point to highlight as well. Thank you, Srikanya. I mean, portfolio companies, right? So the question that I asked both Damian and Amir, maybe the same question to you, is how does GPF influence its portfolio companies? Do you feel the need that you need to sort of push them in that direction, or is it more sort of you're moving hand in hand? And would you also consider, let's say, divestment if there's a company, let's say, that's not meeting goals that or standards you've set, or if it's a drag on the overall portfolio? How do you view that?
Thank you. Actually, I think Damian and Amir already mentioned a lot of key points. I just wonder why I'm the last person to be asked, because I don't have anything much to say. Anyway, I try to say something. Yes, I agree with both of you regarding the engagement and also facilitate the change. But before going to do that, what I'd like to mention is we have to do our internal engagement first. We have to get our investment team to understand what it's all about. Taxonomy, like Amir said, is very important for internally as well. If we don't understand those kind of things in the context, in its own context, how could we engage with those companies? Because we don't have the question to answer. We don't know what to ask. If we get the answer, we don't understand the answer. That's the problem. So I think internally it has to be done first. And then next, we can do engagement with the company that we are investing, or even with fund managers. The key point is what and when, what to engage, what kind of issue we pay attention to, and when, how frequent it is. And that if we don't have that clear internally, and if we don't have policy clear internally, when we come up with a company that don't comply to ESG, and then so what? If we don't have the so what policy, then it could be a problem. In GPF, we have one policy, we call it negative risk guideline. The negative risk guideline means that if we come up with a company that have bad ESG compliance, what we would do as an initial stage, we go and talk to those companies and let them explain what's happening, and let them say what they would do if to change the situation. And then we wait and see. If they do according to what they said and things get better, then we will continue investment. But if not, that's a big question. If not, then what to do? If the company contribute good report, good financial return to you, but then ESG compliance, they are not like that. What should be the right things to do? You are going to sacrifice the investment return because the companies are not doing something good. Can you do that? So this is a big question. So fortunately, as we are the number 2, the second largest investor in Thailand, so lucky that we are that big. So when we do the engagement, those companies comply. But my question still remains: if you are a small investor, what can you do? I don't have the answer for that. I just raise a question. What can you do? Because your job is to do two things. You have to produce investment return for your stakeholders, or your shareholders, and also social return. You cannot sacrifice either of that. How to compromise those kind of things. This concludes my first part about engagement. Second thing that I think very important is you have to have a disclosure agreement with the entity you're investing, and the disclosure has to be according to the global standard. It cannot be any disclosure. If you have that and you understand that they are complying to global standard, then you can rest assured that things disclosed are okay. There's no greenwashing story in there. And the last part that I like to mention, which is in our case is very important, is to have our policy black and white, clearly cut. This is what we focus on. In GPF case, we know that we cannot focus on everything in one go. So we are still in a young fund, as you said. I'm not like Damian. You are very advanced. Actually, I would like to get in touch with you to learn more from you. We are not advanced. We are still very young fund. So we focus only on 4 issues only. To be more specific, to get a substantial progress. We focus on human rights. We apply UN guiding principle and business and human rights as our guiding principles. We focus on climate change. And we try to do more next year. We try to understand our total portfolio, and we try to look forward to like thematic investing, impact investing on climate change. This is the second thing. And the third thing is we try to focus on SDG 11, sustainable city, because we know that we are in our investment in infrastructure and everything, it would impact the city that we are investing. The sustainable city we focus on. And the last part is SDG 12. Sustainable consumption and production. When you have this kind of goal and objective clear, you spell it out. You tell the public, you tell your investee, you tell your fund manager, this is your focus. This and that would shape the way the company that want us to invest to shape their business in line with our objective. And we find that more easier to engage with them because our internal understand. And the investment, the company understand, external fund manager understand, then engagement and working together hands in hand, like Amir said, facilitate the change in the right form is coming along. That's how I see it. Thank you.
Thank you, Srikanya. Actually, I'll ask the next question. I'll let you start with the next question. Apologize for that, but actually, it's good because you touched on 2 things that I wanted to bring up in the next question before we get to the audience questions, which is around reporting mechanisms and avoiding greenwashing. I think is some of the implicit bit on that. So you mentioned GPF relatively new fund. Relatively, I'd say that word. But one of the main challenges faced by institutional investors everywhere, large or small, is that there's a lack of, at least there's a feeling there's a lack of consistent ESG reporting mechanisms, right? If you talk about, I think Damian had mentioned this earlier as well. If you look at across the world, there's an alphabet soup of initiatives that I struggle to remember what all the acronyms, all the letters stand for. And there's always desires to sort of bring things together. So yeah, I just want to sort of get your view, Srikanya, maybe starting with you on how do you manage that? What's the approach that GPF has taken to looking at reporting mechanisms, various global initiatives, and things like that? Or do you sort of say, well, okay, I look at all of them, but I'm going to do something on my own, or I'll set up some sort of disclosure agreement with my individual portfolio companies that's just unique to that company, for instance. Curious to hear what your views are on that.
Yes. 2 things here. Thank you. Then I know it's hard to be the first person. I should rather
flip it around for you. Yeah.
Okay, it's my call, so I have to take that. Regarding reporting and data, so to make things easier for us, we request the company we investing to comply to GI, Global Reporting Initiative, which we find is very comprehensive and very detailed. And I think the team who manage this reporting standard in Thailand, they have a good organization that do the training, explaining what it's all about. And we believe in that. That's the thing that we believe, and we think it's okay if the reporting comply to that. For those other company who cannot comply to those kind of thing, what we look forward to the reporting is the quality of the data. They have to explain why the data is how good the data is reliable, and the consistency in the data. That's the key point regarding quality. And the second point is regarding coverage, whether the story cover all the issue that should be covered or not. And then the consistency in calculating, reporting, whether there's a consistency with the reporting 1, reporting 2, and reporting 3 or not. We have to see in that. And lastly is the frequency of reporting, whether it's reporting every year, every quarter, whatsoever. So mainly if we focus on this kind of thing. And we still think there's still a lot of room of improvement, to make up one report. I think one report, one consistent report, and online one consistent report is something I'm looking forward to. If something like that can happen, what we can see is like a national reporting on the ESG impact or achievement whatsoever, and that would be great. But this is just my dream. Let's see.
Yeah,
maybe Australia already done that. Maybe I think.
Maybe some regulation needs to come in on this. But thanks for sharing that, your thoughts on that. Now, Damian, what about Aware Super? How do you view? I mean, you brought this up initially with on this topic, but how do you see this?
Yeah, I think it's a real challenge. We went through a process last year where we formed our approach to impact measurements. So we went through and we tested about 15 of our direct assets, companies and assets we own, infrastructure, property, agriculture, and we defined some impact that we felt was relevant for those companies. But it was our approach; it wasn't standardised, and I think that there's a great opportunity for us to come together to create some more standardised approaches. As I said, the UN initiative that we've been involved with, one of the key focus areas of that initiative, which the Secretary General called that out because there wasn't standardisation, but one of the key focus areas of that is to create some standardisation. So I think if we can progress that meaningfully, I think it would be incredibly valuable. But then you need to use it and test and get the companies to adopt it and get the investors to adopt it. So I think there's quite a long journey between even agreeing what the key measures should be, whether it's the TCFD approach or something like that that's broadened for SDGs, but then getting it to be adopted by companies and investors, I think will take some time. But that's a critical issue, I think, just to make sure we're all measuring the right things and we're progressing in the right ways.
Great, thank you. And Amir, what about EPF? How do you view the variety of standards out there and initiatives?
No, I think over time we will all coalesce to something that makes sense. So in between that time when we can all coalesce to something that is consistent, I think the organization needs to establish what it can use, and what it sets as the base, as Srikanya has done in Thailand, and it informs its investee entities. Please continue to do this way. It's a matter of screening and so on. I think it's important because when there's clarity, when people abide and do it, then it facilitates us to be able to measure and then to take the right actions along the way. I think maybe one point I do want to stress is I think we can do this in two forms. One is negative screening sort of things, right? Which we've adopted to and done for a long time, right? So whatever assets you're going to go into, whatever assets you already have, you apply criteria and stuff and take decisions against the criteria. But the other thing is actually positive reinforcement mechanisms. So I think in the EPF point of view, what we've done is we've been creating mandates for people to invest in ESG positive initiatives and stuff, and allow the fund managers to actually encourage that to go on. And I think that's been a positive development for us. We're seeing good traction on that line. And we also want to encourage our membership to actually do that also. Because within the EPF scheme itself, once you've achieved a certain level of savings, we allow you to take control of some portion of that saving to invest in funds that are pre-approved by us, right? So going forward, what we're creating now is socially responsible investments that the member himself actually picks up. So now you move away from an average approach of the portfolio returning a certain level, but we give the membership choice to do it. And when we can educate and get that level of influence, yeah, and I think that's also another thing, because you educate also society in that manner to start taking decisions in the right form. And I think that's another initiative that we're trying to do from an EPF point of view.
Okay, thank you. We have, I think, just a little bit over 10 minutes left, and let's take a look at some of the audience questions. There's quite a few that come in, and I think you can all see them as well. So if there's any in particular you want to address or not address or address later, we can do that. Otherwise, I'll sort of maybe look at some of them and go a little bit in order. I mean, the first one. The first one says the recent a recent survey from PwC. PwC 2021 Global Investor Survey points out that 34% of investors are willing to accept a lower ROI in exchange for environmental and societal benefits. However, many sustainability actions require time to mature into a financial payoff. How can this be reconciled with the science that urgent action is needed immediately? I think there's a few dimensions to this question, and it might be as simple as whether you sort of agree with this view or not. Amir, do you have a view on this, or is this something that you think? Do you agree with this statement?
I started with the point that I don't think return is mutually exclusive with
right. So I was going to get you to say you disagree.
Yes. So I think you can find that sweet spot that you can get both returns and good investment. Yeah. However, I think the value of funds like ourselves, we are what they call patient capital, right? Whereby the portfolio effect allows us to take bets for the longer term payout, where the cash comes in a much better form. So we incubate things along the way. By arranging your portfolio in a particular manner, you can take those bets where the longer term payoff actually pays off, so long as the yield is in the right form. So I think that's the value of institutional investors. They can take long investments and shape the portfolio in a longer duration time. And that's what EPF also does. Yeah, we're not short-term players that need to make the earning over a quarter and stuff, right? So the art is in the architecting of the portfolio itself to give the good yield, yet investing for a long-term, good, sustainable return.
Maybe for the second question, Srikanya, maybe I'll give it to you because you mentioned greenwashing. You were the first one to bring up greenwashing. I always, these panels always wait for the first person to bring up greenwashing, and always comes up at some point, right? But the question is, assurance is not a permanent fixture for ESG disclosures. Will large fund managers take a lead role in pushing the need for assured data for sustainability performance to further reduce instances of greenwashing? I mean, I think you sort of addressed this question already. But maybe you can sort of say a few more words for the benefit of this question.
Justin, I think you're right. I addressed the question already. I think Damian has something else to say. Damian, over to you.
Okay. Over to you, Damian. What about well, I mean, do you think large fund managers should take more of a role in pushing for this? I mean, there's something that Aware is doing or thinking about doing.
With regard to greenwashing, you mean, Justin, or avoiding it?
Well, short data for sustainability performance. I mean, yeah. I think getting your companies, your portfolio companies to report what you want them to report and that sort of thing, right?
Yeah, look, I mean, we do try to engage and ask the right questions, but again, I think it's about trying to ensure that we understand the journey on this as well, because it is going to take time. We can't expect companies to deliver overnight, nor fund managers, nor businesses more broadly. So, but I do think it's about asking for the right information and trying to ensure that we understand how we get there over time. I think that the comment earlier around just the requirement for urgent action is really important, because so we don't want to be so hard-nosed about it that we stop people trying. We want to encourage people to take action and to progress. But we also think, and I think Amir made the comment that 2050 is a long way away. I think we've all, broadly adopted a net zero by 2050 type approach, which is great, but we need to be making much more progress sooner than that, don't we? And it's really about encouraging positive progress for companies and investors. having the right measures in place and trying to encourage people to adopt them, so we know what gets measured gets managed, and so really progressing on that path. So I'm a little bit less worried about the greenwashing issue, to be honest, and wanting to make sure that we maximise the energy for people to try and to make progress. I think we may have lost our moderator.
So we are on our own.
Yeah, but I think apart from the issue of greenwashing, I think institutional investors actually have a lot of power in terms of we just have to manage the power in the right form, right? And in the instance, the concept of making sure that we do not have unintended consequences and nudging organizations in the right form. The ultimate tool that we always have is sell and get out of the investment. Yeah. But in between that space, there's a lot of things you can do in terms of engagements, in terms of showing note of protest, writing into the companies, effectively also voting down directors on the board. It's amazing what you can do when you exercise the power of the shareholder. When you make a statement to say so and so organizations have voted against a director on the board, right? Lo and behold, next year you find a stronger alignment along the way. I'm not encouraging to use that willy-nilly, but with good balance, you can achieve a lot.
Sorry, I think I have a technical problem with that camera, but I'm still here verbally. I think Amir, I think we've seen an example, a famous example of that earlier this year, right, with the board, with the engine number one and Exxon being one of them. Maybe Srikanya, maybe this one you can address. The next one is what is your approach if the company refuse to reveal their ESG issues?
Yeah, I think I take question 3 and question 4 all together. How we engage with investee company, you have to make a call, and you have to make sure that it's you who call. It has to be Secretary General. You cannot have a junior staff call. So it has to be number one, make a call. So that when you make a call, the number one leader in that organization will answer your call. That's just how you do it. Secondly, is the company refuse to review the ESG issue. So far, we don't have that experience, because if you have the number one to call, they would report. So it's just a matter of a protocol like that. That's how we experience.
Okay, thank you. And I think maybe one more, maybe let's just look at one last question before we wrap up today. So the last one is how to drive a meaningful, sustainable financing strategies by creating tools, training, and guidelines for companies to incorporate SDG initiatives in their corporate strategies. What do you think? And yeah, anyone want to comment on this?
Again, I think the engagement tool is about the strongest tool that we all have as institutional investors. And when you lay out what your expectations are, and you publish your expectations, and then follow it up through the engagements you actually have, I think you get a lot of good following mechanisms. Yeah, and the more the institutional investor can provide support, whether it becomes in terms of tools, alignments and stuff, the more likely the investing company will move in the right form. And I think that's the approach that EPF actually takes in this.
Great. Okay, thank you very much for that. I think we covered a lot actually in this panel. And I really enjoyed the discussion, and I hope it was really useful for the for three of you and also for the audience as well. Sorry for the little technical glitch at the end. I made a joke about virtual conferences at the beginning, so this is sort of definitely this will definitely happen when you do that. But hopefully at some point we can all meet in person, and if that happens, I won't disappear on stage, I promise. But anyway, thank you very much for joining us today and for sharing your thoughts. Really enjoyed the discussion, and have a good rest of the day and rest of the event. Thank you very much.
Thank you.
You.
Thanks,
Goodbye.
everyone.
Good day.
Take
Cheers.
care.
Thanks.
Bye-bye.